What if I told you the money in your wallet was created digitally inside a banking computer system? It was not mined from the ground, and it was not printed before it started existing in circulation. Most people have never learned how new money actually enters the modern financial system today. But once you understand the process, you will never look at money the same way again. When you walk into a bank and apply for a loan, something very important happens behind the scenes. You might imagine the bank taking cash from a vault and physically handing it to you. However, that is not how modern banking works in today's digital financial environment at all. When a bank approves your loan application, it does not transfer money from another customer's account. Instead, the bank creates a new deposit by entering numbers directly into its accounting system. That digital entry instantly increases your balance, even though no physical cash changed hands anywhere. The money did not exist before the loan was approved by the bank's internal process. This is how most money is created inside the modern banking system across the United States. If you are learning something valuable today, take a moment to like and subscribe to Wealth Decoded. This channel focuses on explaining complex financial systems in clear language that anyone can understand easily. Now let's talk about who oversees and influences the entire money creation structure in America. In the United States, the central authority guiding monetary policy is the Federal Reserve System. The Federal Reserve is responsible for setting interest rates and regulating major banking operations nationwide. When interest rates are reduced, borrowing becomes more affordable for businesses and everyday consumers. Lower interest rates encourage banks to approve more loans, which increases money creation activity. As more loans are approved, additional digital money is introduced into the economy. Today, the majority of money does not exist as paper bills or physical coins. Instead, most of the money supply exists digitally within secure banking databases and electronic systems. Only a small percentage of total money exists as printed cash in physical circulation. The vast majority of money operates entirely through electronic transfers between financial institutions. And this electronic money expands whenever banks approve new lending agreements for customers. However, every loan that creates money must eventually be repaid according to the agreement terms. In addition to repayment, borrowers must also pay interest as part of the lending contract. Interest payments allow banks to generate profit while continuing to operate within the system. But this structure means the economy relies heavily on continuous credit expansion over time. If lending activity slows significantly, the overall rate of money creation also decreases. When money growth slows, businesses may reduce spending, hiring, and investment decisions accordingly. This relationship between lending and economic growth has appeared repeatedly throughout financial history. During economic crises, banks often become more cautious about issuing new loans. When credit tightens across the system, money circulation can slow down rapidly. To stabilize financial markets, central banks sometimes introduce additional digital funds into circulation. These digital funds are created electronically to support liquidity and restore confidence within markets. Such measures are designed to maintain stability during periods of uncertainty or financial stress. At its core, the money system depends on public trust and continued participation. Money maintains value because people collectively agree to accept it in everyday transactions. As long as trust remains strong, the financial system continues operating effectively. If confidence weakens significantly, the economic impact can spread throughout multiple sectors. That is why understanding money creation gives you a deeper perspective on financial reality. When you understand how the system functions, you can make more informed personal decisions. You can evaluate borrowing carefully, manage debt strategically, and think long-term about financial growth. Money today is primarily driven by digital policy decisions rather than physical printing alone. The system continues functioning smoothly because millions of transactions occur within it every single day. From banks to businesses to individuals, everyone participates in the continuous flow of money creation. Understanding this process helps you see the broader structure behind everyday financial activity. If this explanation changed the way you think about money, share your thoughts in the comments below. Leave a comment, share this video with others, and stay connected with Wealth Decoded for more clear insights.